Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, January 14th, and today's market vibe is inflation looks fine, while oil shows up wearing a megaphone.
I love when the spreadsheet says stable and geopolitics says surprise DLC. If your portfolio feels jumpy, that's not caffeine, that's crude.
We've got 5 stories, all finance first. Oil rallying on Iran escalation fears. U.S. producer prices ticking up on energy. An AI chip Hong Kong listing with big Cornerstone investors. Retail traders piling into memory chip makers. And silver exploding in a short squeeze.
Your gas tank is about to become a budgeting app. And somewhere, a silver chart is doing parkour. Let's go.
Story 1. Oil rallied to the highest level since October as traders reacted to rising fears of escalation involving Iran. Specifically, reports tied to U.S. personnel being advised to leave an American airbase in Qatar.
Oil is basically the market's drama queen. One rumor, one headline, and suddenly everyone's pricing in the sequel.
Here's the simple finance. Oil prices aren't just about today's supply. They're about the probability of future disruption. When that probability jumps, traders pay up for barrels now, because replacement barrels later might be harder or more expensive.
So it's like when you hear there might be a snowstorm and you panic buy bread, except the bread is crude oil and the French toast is global inflation.
Why it matters for normal people. Energy hits you fast. Gasoline, flights, shipping costs, even the cost of running factories. And for investors, higher oil can support energy stocks, but pressure consumer spending and profit margins in transport and retail.
Actionable takeaway: if your budget is tight, lock in what you can control. Commute choices, subscriptions, and a little energy spike buffer. If you're nesting, remember, oil spikes can be sharp and mean reverting, so don't chase like it's a lifestyle brand.
Story 2. U.S. producer prices, PPI, rose slightly, with the key driver being higher energy costs, while services prices were unchanged. Think of PPI as the price tag businesses see before you see the price tag.
So CPI is the receipt at the checkout, and PPI is the supplier texting, "Hey bestie, costs are up."
Exactly. Sometimes PPI pressures get absorbed. Companies eat margin. But when energy rises broadly, it can leak into consumer inflation over time, especially in goods with high transport or power usage.
And this is why everyone says the Fed is data dependent, but the data is like a group chat with 200 unread messages.
The practical angle: if energy is the swing factor in inflation prints, markets can whip between rate cuts soon and not so fast. For households, it's a reminder to avoid building a lifestyle that only works when fuel and utilities are cheap.
So maybe don't finance your entire personality around premium gas and same-day delivery. Noted.
Story 3. Chinese chip designer Montage Technology's Hong Kong listing is said to attract Cornerstone investors, including Alibaba and JP Morgan Asset Management. Cornerstones get guaranteed allocation, typically agreeing to hold shares for a set period.
Cornerstone investors are like the friend who shows up early to help you move. Then everyone else thinks, oh wow, this must be legit.
That's the signal. Confidence and demand support. But it's not a guarantee of long-term returns. The finance behind it is market structure. Cornerstones can reduce perceived risk at launch and help stabilize early trading.
So for regular investors, the move is don't confuse big names participated with I can skip valuation. Your wallet deserves due diligence, not vibes.
Story 4. Retail traders are piling into memory chip makers as the AI boom squeezes supply and lifts prices. Memory, like DRAM and NAND, can swing hard because capacity takes time to build and demand can surge fast.
Memory markets are basically everyone forgets the cycle until the cycle reminds them. Then suddenly your group chat is all, RAM is the new gold.
The simple version: imagine a restaurant with limited tables. If a new food trend hits, reservations sell out and prices jump. But if the restaurant doubles seating later, the shortage disappears and prices come back down. That's memory supply cycles.
Actionable.
If you're tempted by the hype, set a rule before you buy. Entry, exit, and max position size. Because I'll just hold forever is how people become long-term investors in bad decisions.
Story 5. Silver surged dramatically, described as an explosive divergence and short squeeze, while stocks dropped and oil climbed. A short squeeze happens when prices rise, short sellers are forced to buy to cover, and that buying pushes prices up even more.
It's like you talk trash online, then the comment section made you apologize in real time. Shorts are basically issuing a public apology by buying.
Why it matters. Squeezes can distort prices away from fundamentals, and that can spill into margin calls and broader risk-off moves. For everyday investors, the key is to avoid leverage and avoid treating a squeeze chart like it's a savings account.
If you can't explain why silver should be up besides it's going up, you're not investing. You're auditioning for a cautionary tale.
Oil's rally is about disruption risk. PPI's uptake is energy-driven cost pressure. AI chip listings are pulling heavyweight cornerstones. Memory chips are the AI supply squeeze trade with a cycle risk. And silver's move is a squeeze. Fast, powerful, and dangerous if you're overexposed.
Your homework. Check your budget for an energy bump. Check your portfolio for one theme overload. And if you're chasing a squeeze, at least wear a helmet. Figuratively. Please. For me.
If this helped, subscribe for tomorrow's briefing and share the episode with a friend who thinks PPI is a new streaming service. Leave a comment with the one risk you're watching: oil, rates, or AI chip supply.
And if your friend says, I don't follow commodities, remind them commodities follow them. Straight to the checkout line. See you next time.